Your VO ETF is not your entire strategy, but for many investors, it has quietly become one. When you peel back the layers, VO isn't truly diversified anymore. It's heavily concentrated in a small group of mega-cap tech giants that are priced for near perfection. One disappointing earnings report from NVIDIA, or a slowdown in AI spending, and your entire portfolio can take a hit in a single week. Guys, 99% of people watching don't like or subscribe to the videos, so please take a second to hit that like button and subscribe. It really helps the channel grow. I'm not telling you to sell VO. That would be a mistake. I'm telling you to reinforce it. After weeks of research, data analysis, and historical comparisons, I've built what I call the ultimate 2026 support squad. 5 ETFs designed to work together, not compete with each other. Each one fills a blind spot that VO currently has. Think of this as air support for growth, a tank for defense, a banker for monthly income, and a secret weapon for when markets turn ugly. By the end of this breakdown, I'll give you the exact percentage allocation based on your stage in life. Whether you're 35 and building, 50 and peak earning, or 65 and ready to enjoy freedom. Let's start with the king. The Vanguard S&P 500 ETF, VO or IVV, is the foundation of most long-term portfolios. It owns 500 of the largest U.S. companies and constantly refreshes itself as winners rise and losers fall. But here's the problem. It's market cap weighted. As of early 2026, the top 10 companies now make up nearly 38% of the entire fund, the highest concentration in decades. When you own VO today, you're not broadly betting on America. You're betting on NVIDIA, Microsoft, Apple, Amazon, Meta, Broadcom, Alphabet, Tesla, and Berkshire Hathaway. 8 of the top 10 are tech or communication stocks. The expense ratio is an excellent 0.03%, and the dividend yield is about 1.2%, but concentration risk is real. For aggressive growth, many investors pair VO with SHG. While SCHG is a great ETF, it largely owns the same stocks as VO, Apple, Microsoft, Amazon. That's not diversification, that's duplication. If you want true growth exposure in 2026, you add SMH, the VanEck Semiconductor ETF. VO owns the software companies benefiting from AI. SMH owns the companies building the silicon that makes AI possible. NVIDIA, TSMC, Broadcom, ASML, these are the picks and shovels of the AI infrastructure boom. SMH is volatile and more expensive at 0.35%, but it offers focused, high-conviction exposure to the physical AI build-out. Next, we need income. Enter JPQ, JP Morgan's NASDAQ Equity Premium Income ETF. It yields roughly 9 to 11%, paid monthly. This isn't a yield trap. JPQ uses covered calls, collecting option premiums in exchange for giving up some upside. In a volatile or sideways market, this strategy shines. The trade-off is capped upside, but in return, you get consistent cash flow. One key note: most of JPQ's income is taxed as ordinary income, so it works best inside a Roth IRA or tax-advantaged account. If JPQ is your banker, SCHD is your tank. SCHD yields around 3.5% and holds 0 Magnificent 7 stocks. Instead, it owns defensive, cash-rich companies like Coca-Cola, Pepsi, Chevron, Lockheed Martin, and healthcare giants. These companies hold up when tech cracks. SCHD dividends are fully qualified, meaning lower taxes, and its expense ratio is just 0.06%.